Hello and welcome to our 16th annual Marine Money Virtual Gulf Ship Finance Forum. Now, Mia and I would much have preferred to have been in the Emirates Towers Hotel with you sharing a coffee before we start, but unfortunately in the world that we live in, that's not possible. And therefore we're very glad that we have this opportunity to meet, and the connectivity that these webinars give us is excellent in terms of people meeting together from all over the world to hear the news from the Gulf in November 2020. We'll have 3 sessions today. The first one now at 12 o'clock Dubai time, another one in 2 hours at 2 p.m. And the third one at 4 p.m. Dubai time. I hope you'll be able to listen in and join them all. Our first session looks at oil demand, supply and activity in the Gulf region. And I'd like to invite Mr. Lars Eirik Nicolaisen, Senior Partner and Deputy CEO of Rystad Energy, to give a presentation on the topic. Lars, over to you, please.
Thank you very much, and thank you for the invitation to present and share some of our views, I guess, of the market in these very, very special times. So I'll try to touch on all the subjects you mentioned there: oil demand, oil supply, which are indeed global phenomenons, and then try and say something about how this will trickle through to activity in the Gulf region. For those of you who do not know us, many of you probably do, but I tend to use this map as an illustration of where we are coming from as a firm. Rystad Energy is obsessed with the idea that data is the way to go about to give advice to stakeholders in an industry. And we've been doing that ever since 2004. We've been building a database of the upstream oil and gas projects of this world. And this is the foundation on which we draw conclusions and also projections about the future. So everything that I'll be saying today about the future is looking into this database of the upstream oil and gas projects of this world. And in addition, we've added to this inventory by also now covering renewables. But I won't turn this into a commercial for Rystad. I'll rather quickly now shift gears and jump into the meat of things and talk about the state of the industry and the state of the oil markets. And I think it's very natural to start off by zooming out and looking at the oil market from a 10,000 feet view. And that's what I'm doing here. And I wanted to just sort of emphasize the unprecedented situation that we have unfolding now in 2020. What the chart here shows is the growth of the oil markets as we recall it since the year 2000. And really, this has been a story, a rather stable story of a market that grows at a pace of about 1 million barrels per day on an incremental basis every year. There's been exceptions to that. We all recall the financial crisis, where this market in aggregate contracted by some 1.5 million barrels per day over 2 years. Now, fast forward to 2020, a year in which when we entered, we expected the markets to continue to grow at a pace of about 1 million barrels per day. Fast forward till what we know today, and we are looking at a contraction of this market, which has no parallel in history. And it's literally off the charts. We're talking a contraction of 10.2, that's an estimate, million barrels per day on a year-over-year basis. So this is the backdrop. This is what we are struggling with. And I wanted to just sort of further emphasize a little bit why it is that the pandemic, COVID-19, has had such a tremendous impact on the oil markets, and more so an impact on the oil market than on the general economy. And the reason for that is because of the makeup of the oil market. So to just remind you all, if we look on the left-hand side here, a pie of about 100 million barrels per day, which is the makeup of the oil market in 2019, a big portion of oil consumption has to do with mobility, transportation of people on roads or in the air, or transportation of goods on roads and in the air. And as such, when a pandemic hits and we need to hinder the spread of such a virus, it's all about hindering mobility. And as such, the pandemic has hit straight to the heart of the oil markets. If we look at those two sectors, road transportation and aviation, that's what we're doing on the right-hand side. And we're doing this on a more highly resoluted time axis. So you recall here that in the middle of April of this year, activity on global road traffic was down some 33% as a response to the societal sort of impacts or regulations that we put in place in order to cope with the virus. However, since then, since that situation in the middle of April, things have started to normalize. And you see that as the red line starting to move north and moving towards the 2019 level, which is that horizontal solid gray line that you can see there. But still, we are trending below where we used to be, and we are still, facing headwinds as a market from the road traffic around the world. On the other hand, on aviation, we were down 83% at peak. It has also normalized, but not to the extent that road traffic has. And we are still struggling with a massive headwind with regards to lack of air traffic around the world. So the market is still significantly impacted by COVID-19. I'll get back to the balance and how we believe that this will trickle through to oil prices in the near term. But I wanted at this stage to take a little bit of a step back, because very many are asking themselves the question, how will COVID-19, will it just be a transient that is over in 12 to 18 months, or will it have more lasting effects on the oil market? And I wanted to try and answer that question a little bit, because I think what's on everyone's minds, leaving COVID-19 aside, is the construct of the energy transition. And for many of us, the manifestation of the energy transition is through this peak oil demand scenario. And I think it's becoming increasingly common, also before COVID-19, to believe in a peak oil demand scenario that unfolded in the late 2020s or in the early 2030s. And what I'm doing here is just to remind you about Rystad Energy's view of the world with regards to peak oil demand as we saw it pre-corona. So let's think about this as a January 2020 view. We were arguing that oil demand would reach a temporary peak in the late 2020s, 2028 that is, and then start to decline. Very much driven by the passenger vehicle segment, which continues to make up a very big part of the market. And with electric vehicles penetrating as quickly as they are, that almost in and of itself is a reason to make markets roll over in the late 2020s. Anyways, that was the view we had in January this year. Now, what does COVID-19 as a global phenomenon, what does it do with the energy transition, and maybe specifically the energy transition manifesting as an peak oil demand scenario? And I wanted to discuss that a little bit with you here in a framework that I've outlined on my screen here, because I think there are arguments for COVID-19 having a postponing impact on the transition and an accelerating impact on the transition. So I wanted to weigh these a little bit against each other, and I wanted also to see the argumentation through 5 distinct lenses. And the first lens has to do with commodity prices in and them of itself. After all, low oil prices makes substitutes for oil less competitive. And as such, you may argue that the months that we have put behind us now with low oil prices have been a good thing for oil demand, and at the margin, maybe even postponed the transition. On the other hand, what we are seeing contours of now is that the current lack of investments into oil supply sets the stage for a potential spiky oil price recovery whenever demand normalizes. Because the question remains, do we have enough oil from a supply perspective to deliver on a demand that comes back in 2022, 2023, whenever it comes back? Because we have invested very little in upstream over the past 10 months. And if we've done anything, we've actually shut in wells. And if prices comes back in a spiky fashion, that in turn will probably accelerate the transition because it will make substitutes more attractive relative to oil. What about transportation sector? On the one hand, we are seeing that people are fearing the use of public transportation. We're also seeing that people are moving out of cities, the big cities of this world, as a response to the pandemic. As such, they are effectively stimulating a key sector for oil demand, which is use of personal vehicles and road transportation. On the other hand, I guess we can all agree that we are now on a 12 months intensive course in video conferencing. And also the fact that people will likely fear leisure travel for a certain time going forward. We've also seen bicycles as part of the global transportation system having gained market share. So those are all arguments for an acceleration of the transition. What about public opinion and focus? On one school of thought would argue, well, society cannot really afford to focus on climate change while we are being occupied restarting our economies on the back end of the pandemic. On the other hand, you may argue that through the pandemic, the society in general has become aware that these global known unknowns, the global phenomena that scientists around the world has warned us about, can impact our daily lives. And as such, you may even draw a parallel between COVID-19 and global warming and argue that the attention towards those kinds of phenomena will intensify among us. What about government interventions? On the one hand, you may argue, and we have already seen, that certain governments around the world have been right-sizing their fiscal regimes with regards to the oil and gas industry. And as such, we are stimulating investments into that legacy industry as a means of restarting our economies. We've done so in my home country, in Norway, for example. On the other hand, we are seeing that nations around the world without hydrocarbon accumulations are effectively putting a lot of their stimuli packages in the wake of the pandemic directed towards new energy solutions, which are in turn accelerating the transition. What about investments in renewables? Well, on the one hand, renewables has not been shielded to the global sort of meltdown of the economy, and in particular, the local currency devaluation that has happened for local currencies against the dollars have impacted profitability of renewables projects in particular. That is as opposed to oil, because in renewables, you're incurring your costs largely in dollars, but you're selling a commodity that is priced in a local currency, power that is. In oil, however, you're also incurring your costs in dollars, but you're selling a commodity that is also priced in dollars. So renewables are particularly vulnerable to local currency devaluation. On the other hand, and an argument for an acceleration of the transition, is that certain subsidy schemes associated with renewables that were originally planned to be phased out during 2020 has been maintained in place, partly offsetting that negative climate that I just described on the other hand. So a very two-handed set of arguments here, and I'm sure all these sort of discussions are very familiar to you, and I will say that the jury's out on most of these, on how this will actually trickle through. But if anything, and I think this is more getting to conventional wisdom by now, if anything, the energy transition has probably been, at the margin, somewhat accelerated by all these phenomena that are incurred by the pandemic. So returning to my framework of peak oil demand and where we see this heading, we argued that the inflection point would be 2028 in January. We are now saying the inflection point will probably be 3 years sooner, 2025, before the market starts to roll over and decline. But we are not arguing that peak oil demand is behind us, which certain other institutions are. And I will sort of acknowledge at this stage, and I will put a logo in here, a familiar logo for many of you, and I'm sure many of you follow DNVGL's forward views of the market, and they are a very thoughtful institution in that regard. And what I'm doing with my slide here now is basically just to acknowledge you can indeed create more radical scenarios also, because again, the jury is out on some of the phenomena on my previous page, and as such, it may be that the peak is behind us, but our base case argues is not. It's some 5 years ahead of us. That said, I think very many stakeholders, including the big oil companies of this world, are taking all this uncertainty into account when they're making decisions in go-forward investments. So therefore, this discussion is so relevant. And I wanted to segue from here into a framework where I wanted to discuss a little bit what kind of themes the oil companies around the world is taking into account when they make investment decisions. And I think it's fair to say that such themes tend to follow the cycles and they tend to vary over time. I want to make the argument that during the heydays in 2007 to 2013, an industry upcycle, materiality and volume upside was thematics that the oil companies tended to focus on. They all communicated around lofty volume targets from a production standpoint and reserve replacement ratios. As the downturn hit us in 2014, that mantra swiftly shifted towards keywords becoming robustness, and cash preservation, balance sheet repair, etc. And I think in 2019, and again, this has nothing to do with COVID-19, there was some words added to that vocabulary. Optionality and sustainability being two key parts of that. Optionality meaning that the oil companies of this world, realizing all that uncertainty that is ahead of us with regards to peak oil demand, they prefer projects that leave them with a lot of optionality, a lot of decision gates going forward, so that they can quickly recoup the small capex tickets that they are putting down into the ground. Sustainability being all about the ESG phenomenon, which is largely penetrating, and now not just the European phenomenon, but also the American investor community is starting to focus much more on ESG. And it is, as we speak, trickling through to decision criteria for oil companies and also NOCs around the world. So let's talk a little bit about those two sort of aspects and how sort of various investment themes addresses the optionality and sustainability aspect of the oil and gas industry. And the first part, optionality. Optionality, another word for that is short-cycled. And another way of articulating the phenomenon that I spoke to on my previous page is to say that oil companies will favor short-cycled projects going forward. And on that note, it's useful to contrast between two big asset classes that many of us on this call know very well, meaning the global jackups and the global floaters as the two constituents of the global movable offshore drilling unit market. And just realizing that the makeup of the demand, the project inventory that underpins the demand in those two markets are vastly different. And I think we all know this, but I'm just reminding you that the global jackup market is largely one that is driven by short-cycled brownfield work, infill drilling, and workover. Whereas the global floater market is one driven by blue and green type of activities, exploration and greenfield development. Those are long-cycled in nature. The customers, it requires them to put in long bets on the oil market when undertaking those kinds of activities. This is an argument for a relative robustness of the global jackup market compared to floaters because of that short-cycled investment profile that underpins its demand. And as you all know, the Middle East is largely a jackup market. I'm comparing the big regions of this world here with regards to the makeup of the overall movable offshore drilling unit market, Middle East being a large market at the outset, and it's dominated by jackups. So coupling this slide with my previous one is one that gives you an argument for Middle East and remaining a relevant offshore region because of its short cycle investment opportunity space represented by all these infill workover type of activities. And add to that the fact that the cost competitiveness of the resource base in the Middle East is unparalleled. The benefits of scale that the large reservoirs are adding gives a superior economics from a break-even standpoint. And that is why we see the Middle Eastern region being a very, very relevant one from an offshore perspective going forward. I'm going to segue on to looking at a forward projection of activities in the jackup market as a whole. So recognize my y-axis here as a global measure for activity in the jackup markets, demand for jackups in rig years. Recognize how we are arguing that profile will peak out in 2019, contract now for 2 years, reaching a temporary bottom in 2021 before it reinstates somewhat of a global growth trajectory. However, also recognize how Middle East is carved out as the lower part of my chart here. And as you can read from the labels, Middle East is gaining market share in this global jackup market. And it's all because of the reasons that I just pointed towards, the cost competitiveness of the resource inventory and the short cycle profile of the inventory. The other part of the investment theme mantras of the oil companies of this world has to do with ESG. And once again, the Middle East and offshore resource base is offering a superior profile, largely because of its benefits of scale. The larger reservoirs you have, the more benefits of scale you can reap as you dimension and build out your infrastructure. And as such, on a energy consumption per barrel of oil equivalent produced, you are reaping benefits. And that is very much a proxy for CO2 emissions per barrel of oil equivalents produced. And as you recognize here, through a very, very high level benchmarking between various resource themes around the world, Middle Eastern offshore shelf region is offering a superior footprint from a emissions per BOE standpoint. So I've given you a few arguments now for I guess a fairly constructive view of the future on behalf of jackups in general and on behalf of the Middle Eastern part of that jackup market. Let me take a little bit of a step into the more macro side of things again and become a little bit more near-term oriented. I'm going to visit a slide here, and I'm closing in on the end, so bear with me. I'm going to show you a slide here, which is a typical one that we tend to derive as oil analysts. It's a classic supply-demand outline of the oil market. So recognize the green line as our supply of liquids or oil globally, and the red line as a demand line. The gray columns in the background represents the difference between those two, which is an implicit inventory build or an inventory draw. And you recognize the vast imbalance that was playing out in the beginning of this year, peaking out in April of this year, when the market was imbalanced at a pace of about 24.4 million barrels per day. However, that situation has largely normalized by now, not just because demand has responded somewhat positively, as we talked about earlier, but also because global supply contracted swiftly in the month of May. And come the month of June and July, these markets were largely in balance. And as you can tell by our forward projection here, we expect these markets to remain in balance going forward into 2021. However, do notice my warning sign to the right-hand side here. This balance is a fragile one, I will say, because it relies on OPEC continuing to manage the markets. And actually what we've baked in here into our base case scenario is an assumption that OPEC continues to hold back volumes from the market and do not come back with volumes as they have originally planned to do in 2021. So it's all eyes on the meeting that is taking place in a week from now. OPEC is meeting. We are very excited to see what comes out of that meeting, but we are expecting and I guess hoping for them to continue to reach a conclusion that they shall manage this market from a supply side also during 2021. But if it gets us through 2021, if we get a vaccine, we'll get a more normalization of the demand side, then 2022 can be the year when these markets start to normalize from a more fundamental level and not from an artificial one with OPEC being the managing entity. So from an oil price point of view, we kind of argue that the forward curve is not that far away from where we expect things to trickle out. We recognize the forward curve as the solid line into the future here. The dashed line is our case for how this will evolve. It's going to be a fairly slow journey from here towards a normalization in 2022. We expect a certain peaking out in 2023 because of the phenomenon that I alluded to briefly earlier on, because part of the supply of oil has been curtailed in a fundamental basis over the past 10 months. And we have invested very, very little in our ability to produce oil over the past 10 months. And as such, when demand normalizes, we may even witness a shortfall for a limited period of time. That's what we are indicating by this upcycle that reaches a temporary peak before rolling over into more of a normal state, which we consider to be a mid-50s going forward. So that was a few glimpses into our crystal ball, which is, I guess, one out of many such crystal balls out there. But hopefully you found this interesting and stimulating. And again, thank you for having me.